Brian Stevens here with the National Real Estate Post. I have Tom Hutchins and John Su from Angel Oak, and we're going to have a conversation about non-QM and about the patch. Yes, the QM patch that everybody's talking about right now, and what it's going to do to the non-QM market and the mortgage market in general. So, guys, how you doing today?
Awesome. Great, Brian. Thanks, Brian.
Cool. There's a lot of conversation going on about this, and I think there is a lot of misinformation that's going on about this. So the non-QM patch, which is going to, it's a January 10th, 2021, so we've got about a year and a half left on this. The articles that I'm reading on this, let's jump right in, is the concern is that it's going to lead to a wider berth of more risky non-QM products that are going to start to dip their feet into what we would call the subprime market of years ago. Is that true or not?
Yeah, see, I think that's a very common misperception, Brian. It's actually what it's going to do. It's going to stop Fannie Mae from actually originating non-QM loans under that QM umbrella. That's really what the patch was. Is DTIs over 43. Fannie Mae approve them, as an example, they can give that a QM designation, but that's a non-QM loan. That's very clear in the Dodd-Frank. So once this patch is removed, it's not necessarily going to create more non-QM loans. It's simply just going to call a non-QM loan what it is. It is a non-QM loan, whereas today they're originated as a QM loan.
So again, the big concern is what's going to happen with the ability to repay? Are Alt-A or non-QM providers like Angel Oak then going to be able to offer a wider berth of products that don't have to deal with the ability to repay?
Absolutely not. The ability to repay is part of the Dodd-Frank Act, and that continues without the QM patch. So we've been doing this exclusively for 5 years. Every single one of our loans has to have a documented ability to repay. And that continues as long as the Dodd-Frank Act is in play.
I would say that the removal of the patch is allowing the marketplace to dictate what the market feels is good credit. The QM patch created this false sense of creditworthiness because Fannie and Freddie were able to put their stamp on it and say, okay, this is a good credit. But now, with removal of the patch, the true capital markets will come in, make a determination. These types of loans should be made. These types of loans shouldn't be made.
So this just squelches any idea of having a stated income loan going forward. That's not going to happen.
That will not happen. That will not happen. Documented ability to repay remains.
How do you feel about that?
I think it's great. We've from the very beginning, we've always said that we want to do responsible non-QM lending. This is not a repeat of 2005 and 2006. And that regulation helps keep everybody on the same playing field.
But I digress here for a moment. Just between us, can you not offer a responsible stated income deal? See, this is where I kind of differ with you guys. I'm just saying, I think theoretically we should be able to offer a responsible stated income deal for that self-employed person, with sourced and seasoned reserves and a large down payment. Isn't that a reasonable loan?
Yes, but who decides what's reasonable? That's where I would be concerned of a repeat of 2005, because it would be up to every single person. We agree 100% with you that yes, there are reasonable, good loans, good borrowers that a stated income loan makes sense, but without a fine line there, then it becomes everybody's interpretation.
Yeah, that W-2 employee who's a short order cook at Denny's is not an executive chef. I totally get that. But yes. I want to segue here. You bring up a good point. So in 2017, there was speculation from the Mortgage Bankers Association that non-QM was going to go up by 400% in the next 3 years. In 2018, from 2017, you went from a $2 billion industry to a $5.3 billion industry. Where is the non-QM market right now on its growth patterns?
It is the same trajectory, Brian. We set another record last month in July. We're seeing our business from last year more than double. So and this is without the QM patch. This is just the non-QM business that the borrowers that were cut out completely post-crisis. So that growth is going to continue with or without the patch.
I think the 2018 number is probably more in lines. I know from the securitization perspective, it's about $12.5 billion. And I think we're on pace to hit 25 billion this year in securitization. I know Angel Oak already has done more securitizations to date this year than the entirety of 2018.
So what's it hypothetically? We lose the QM patch. I see. I still think that if we go out of conservatorship, which would get rid of the patch, or if January 10th, 2000, or what is it? 20 what year? 2021. 2021. God, I'm missing it by decades. This is what happens when you get older. I think that the GSEs are going to adopt something that looks like the QM patch. I just don't see this thing passing. But what are the concerns? If we lose the QM patch, what would that allow a non-QM lender to do that you simply can't do now?
I don't know that it would even change what we do today, Brian. I think it would just put more borrowers, take them out of that QM umbrella and make them what they are, non-QM borrowers. If you have a 49 DTI right now, you are considered a QM borrower, could be considered a QM borrower. After the patch is removed, no, you are not a QM borrower. And so some people have argued that QM borrowers have been footing the bill for the non-QM borrowers through Fannie Mae. So rates have actually been a little bit falsely inflated to cover that additional risk of borrowers, which is probably 15 to 20% of agency production today.
That's exactly what I was trying to make earlier, Brian, is that right now with the removal of the patch, the marketplace will determine what good credit and bad credit is. Implicit in that statement is pricing, right? So if you are a QM, non-QM borrower, as Tom just said, you may not be paying 3 3/4 anymore. You may be paying something higher, right? Because the marketplace is deeming you 49, that's kind of high. Now, I'm not saying you can't afford that and you've got a lot of reserves and it makes sense, but,
sure.
But it's not 4% for you, okay? But with the patch, you were getting what may some people consider an artificially low rate.
So I think what I hear you guys saying right now is it sounds to me like you think by losing the patch we'd have more responsible lending.
I think it'd be more real.
Yeah.
Yeah. A non-QM borrower is a non-QM and a QM borrower is a QM. So there would be clear delineation.
So, the point that I brought up, and tell me if this is right or wrong or misguided, because your industry is growing so much, it's the largest growing facet of the mortgage industry by far. I mean, it's lapping those who don't offer non-QM deals. That what we've seen is we've seen a lot more players come into the game in the past year and a half. I mean, Angel Oak's been around for a while. You guys were one of the first ones to jump into this. You've seen more competitors, other non-QM borrowers. My premise was that these competitors are going to come in and try to offer riskier products, maybe lower credit scores, maybe lower LTV, and that it's going to be, some of the mainstays who's been doing non-QM like Angel Oak, who might then feel compelled to go ahead and start offering some of these risky products. John, why do you not see that happening?
I don't see that happening in any great size because ultimately, unless these originators have the ability to hold these assets to term, there has to be a secondary market takeout. You have to sell it to somebody. And unless that person has an ultimately enormous balance sheet, it has to access the capital markets somewhere along the line. So I find, in my experience, the rating agencies, the bond investors are very, very laser focused on the credit quality of the underlying portfolio. So, offering a 90 DTI, a 90 LTV to a 500 FICO bar, it's not going to fly, right? And you can try to get some volume by doing that, but there will be no natural buyer for that. So I really think that an entrance coming into the market without access to the capital markets, without having a reputation with the rating agencies, in relationship with bond investors, I think that's going to be a very limited window of opportunity that they can make a mark. And if they can't access those players, which I'm arguing they cannot, then they're going to be a player for a very, very short period of time.
So I saw Alan Greenspan came out either today or yesterday, and he says that there is no barrier to treasury yields falling below zero right now, as we've seen in so many markets around the world. Are investors not going to be then interested placing their money somewhere else where they get some type of return on it? And could that not create an opening for more risky products?
I think ultimately, we don't necessarily need to go there, right? We're actually originating a lot of good credit, and we're offering very compelling yields. I mean, the spread between agency and non-QM is still pretty large. And, I think our biggest challenge, Tom's biggest challenge every day, is getting the word out to the borrowers that there's actually a program for you, right? Referral sources. And I've heard
originators, realtors, so everyone in the real estate.
I think we're a great distance from having to really go to the paint the corners of the credit spectrum in order to gin up volume. I think we're far, far from that.
Well, and right now you really kind of have to look at growth, don't you? I mean, it's like, how much more do you want to grow than what you guys are doing right now? And you're doing it with the products that you're currently offering. There's such a big market for non-QM, and it trips me out when I still hear some regional mortgage banking operations who are hesitant to jump into the non-QM market, because you got to offer what your people want. So I mentioned a moment ago that I've run across a number of lenders who are hesitant to jump into the non-QM market. What would you say to them?
Well, we've been saying all along, it's a safe place to play. We've been proving it for 5 years now, but with this QM patch possibly being removed, that's going to take 15, 20% of the agency business right out of agency and into non-QM. So if you're a mortgage banker and you're not participating in non-QM, what are you waiting for? You need to be ready, because that's where all these borrowers are going to land. Plus, it's the fastest growing space right now, even without the QM patch. So you have loan officers that are missing on loans and sending them down the street to your competitors. And I don't think that's a really great business model in any market.
I agree. If you ignore that, you are going to lose 15 to 20% of your volume today, right? And then you're just totally ignoring the growth aspect of the program, of the loans you're not even getting today, right? So take today's volume, cut it by 15, 20%, and say, okay, are you okay with that? Most businesses cannot survive that. And then you're ignoring the fastest growing segment of the mortgage market. So again, I echo what Tom's saying. I don't understand why large originators, large regional, or any originators actually kind of ignoring this. They're doing it at their own peril.
With limited inventory, limited production going on right now, I know that we have this refi boom, which is kind of giving just a moment of pause for some of these lenders. But, with a looming recession or some type of pullback on the horizon for a lot of these lenders, in order to compete and possibly even survive in the coming years, it seems smart to get ahead of this thing. Don't you think so?
I don't think any lender can afford to turn away borrowers. I just, regardless of the refi boom that's currently happening,
right,
and how long it's going to last, don't you want to always have a good mix of purchase business? And non-QM has really kind of proven to be a terrific purchase product for originators to go out there and talk to realtors and others in the business about these types of loans, and these types of borrowers can now buy a house. I think you want to have that conversation regardless of what's happening in the market.
You know what trips me out, especially as a loan officer, and this is just personal, but I remember I had some deals in years past. You'd paint yourself in a corner on a Fannie Freddie Ginnie product. And I remember thinking I would write a check to get out from underneath this mess that I made for myself. And so I think every lender's probably been there at one point. It's like, I will literally write a check for thousands of dollars. I think it's really cool what you guys have to offer right now, where a loan officer can go in there and put the parameters in and find out in just a moment's time if they can go ahead and get that deal qualified. So this is a way from going from a chump to a champ in a couple of seconds, and going from, that anguish of feeling like you would write a check to get out from underneath it, to actually earning a check and providing a service for your clients, community, and real estate agent referral partners. So can you talk about that just real quickly? Because I know people hear us say it on the show, but tell us what that looks like.
Well, so there's a couple things that I'd like to touch on. One is that the successful loan officers actually use non-QM not necessarily as a fallout, but as a way to open new doors. Calling on realtors and different people in the space and saying, hey, these borrowers that you have thought, we've all thought they cannot get a loan, they can now get a loan through me as the expert in the non-QM space. So that's a big piece of it. But then, yes, our technology, we just rolled out a tool called Quick Qual, and it allows you to go in and hit a few buttons and upload a borrower or reissue a borrower's credit and get an immediate answer on approval, basically a DU approval without DU on whether or not we can do that loan for that borrower. So the speed at which these loans can get done is every bit as fast as an agency loan. And those are the kind of things that, we've worked on real hard to make these loans easy to originate. And our customers will tell you working with Angel Oak does that.
I talk to a lot of loan officers, and one of their biggest problems is call reluctance, hesitancy to call up the real estate agents, because you're all offering the same meat and potatoes for dinner. I mean, that's what it is. Or you're asking for a handout. Like, this would be a really great strategy if you're watching for a loan officer right now, if you're watching this and want to have a compelling reason to call a real estate agent. I'm dead serious. Here's what I would do. I'd pull up the quick call. I would call those agents who I've worked with, the ones who know me or are familiar with me. Maybe I did a deal with them in the past, that big birth of real estate agents. I'd call them all up, and I'd say, hey, Brian Stevens over here with ABC Mortgage. Listen, I want to know if you have any turndowns right now. And can you give me the parameters of the turndowns? And if the agents have the parameters of the turndowns, I would put it in the quick call, and I'd say, we might have a fighting chance with this. It gives you a reason to call your real estate agents. You can call them all in a day. And in the process of doing that, if the agent says, no, Brian, we don't have anything right now, you could say, great, is there anything I can work on with you right now? Is there anything else that we can work on together? And it really puts your foot in the door for what you're currently offering, but you can't do that unless you have these type of products. I mean, when you look at the marketing component to non-QM deals, it's so much more remarkably wider than what people are doing right now. And because there are some lenders who won't do non-QM, that's just an opportunity for you if you do, in fact, offer non-QM deals. Hey, is there anything you want to say in closing to those of you possibly who are still on the outside looking in and, scratching their head saying, I don't know if I want to do this?
Well, I would say what I've already said. It's you need to get in. You need to learn non-QM. You need to originate these loans. Go to our website, angeloakms.com, and just check us out. We've got a lot of our product information. You can find a local account executive who can come into your office and sit down and show you the products and the programs and the process on how to get these loans closed. The thing that I would say is the time is now.
Hey, listen, guys, for those of you who've watched our show for any length of time, we've been with Angel Oak for a long time now, and we constantly get positive feedback from our base all the time. This is a company that you want to align yourself with because this is the direction of the market. Even if you don't like it or want it, it's happening without your opinions. So, if you want to catch fish, I would go recommend fishing in a pond with a whole bunch of fish in it. And that's what you're going to get with non-QM. So, guys, thanks so much for the time, and thanks for clarifying. That's really interesting. I didn't really get the angle about how this is really going to push more of the market towards non-QM. I mean, that's a real trippy angle.
That is absolutely what's going to happen.
Happening.
And so we appreciate your time. Thank you, Brian.
All righty, guys. Have a good one.
See ya.
Later.